Credit card interest can be confusing, but let's break it down in a simple way. When you use a credit card, you're borrowing money from the bank, and if you don't pay it back in full by the due date, they charge you interest. This interest is essentially the cost of borrowing that money. Most credit cards give you a grace period, which is the time between your statement date and the due date, usually about 21 to 25 days. If you pay your balance in full during this time, you won't be charged any interest. But if you don't pay at all, interest will start adding up on the unpaid amount. The interest rate on a credit card is called the annual percentage rate, or APR. Even though it's listed as an annual rate, it's actually applied daily. Here's how it works. The bank takes your APR and divides it by 365 days to get the daily interest rate. So, let's say you have a credit card with a 20% APR. Divide that by 365 and you get around 0.055% per day. That might sound small, but it can add up quickly. For example, imagine you have a $1,000 balance and don't pay it off. At 0.055% per day, you'll owe about 55 cents in interest on that $1,000 the first day. But here's where it gets tricky. Interest is compounded daily, which means the next day, you're paying interest not just on the original amount, but on the balance plus any interest from the day before. This means your balance grows a little each day if you don't pay it off. So the longer you wait to pay, the more interest builds up, and this is what makes carrying a balance so costly. If you only make minimum payments, most of your payment goes toward interest, with only a small amount going toward the principal or the original amount you borrowed. That's why making just the minimum payment can keep you in debt for years. Let's put this into perspective with an example. Say you have a $1,000 balance at 20% APR, and you only make the minimum payment, which is usually around 2% of the balance. You'd pay around $20 for your first payment, but because of interest, only a small part of that actually reduces the $1,000 balance. This means it can take years to pay off even a relatively small balance if you're only paying the minimum. To avoid interest, the best thing you can do is pay off your balance in full each month before the due date. This way, you don't pay any interest and can take advantage of the benefits of using a credit card, like rewards and building credit, without the added cost. If you can't pay it all off, try to pay as much as possible, more than the minimum. This reduces the amount of interest you'll owe over time and can help you get out of debt faster. In short, credit card interest is the cost of carrying a balance, and it can add up quickly because of daily compounding. By understanding how it works and aiming to pay off your balance as soon as possible, you can avoid costly interest charges and keep your finances in check.